Hello friends. In this video we will discuss a very important topic of banking, that is repo rate. Now first of all, what is repo rate? We all know that whenever we require funds, we are having financial crunch, we go to the banks and we take the loans. So whenever you are taking a loan, you have to pay a rate of interest. Similarly, whenever the commercial banks or any financial institutions, they face shortage of funds, what they do? They go to the country's apex bank, that is Reserve Bank of India, that is the topmost bank in the country. So these commercial banks go to this Reserve Bank of India and they take the loan. So whenever they are taking the loan from the Reserve Bank of India, they will be charged a rate of interest on the principal amount. So this rate of interest that Reserve Bank of India charges from the commercial bank is called repo rate. Now, what is the full form of repo rate? Repo rate is an abbreviation which is used for repurchase agreement or repurchasing option rate. Now, what is this repurchasing? This we will discuss further. So, how the system works? So, whenever a bank require the funds, they will be taking a loan. Now, why the Reserve Bank will give them loan? Against certain kind of security. Now, what are these securities? These can be treasury bills, gold, paper bonds. So, this will be given to the Reserve Bank of India. These are called eligible securities. And for this, the commercial banks will be getting a loan and they will be giving a rate of interest that is called repo rate. And when the commercial bank is having sufficient funds, what they do? They repay this loan and they repurchase the securities that they have given in the above step. That is why the full form of repo rate is repurchasing option rate. So first of all, they sell the securities for the time being, take the money, pay a rate of interest, and when they have sufficient funds in the 1 day or 2 days, they repurchase their securities. So in the nutshell, we can say the Reserve Bank of India and the commercial bank, they reach at an agreement that the commercial bank will be repurchasing the securities and the price is already set. So when the banks is having the shortage of funds or they want to maintain the liquidity, so this entire system works. So generally we get confused among these two terms, what is repo rate and what is bank rate. So there is a very minor difference. Whenever the banks are taking loan from the commercial bank against any kind of security, if they are giving the securities. Now what are the eligible securities that we just discussed? The government securities, bonds. So whenever the bank is giving a security to RBI, it will be called a repo rate. But when the loan is taken without pledging the securities, it will be called a bank rate. So these days the repo rates are always changing. So what is the current repo rate and how it is determined? So this is the Reserve Bank of India which regulates the repo rate and how they just try to control it based upon the economic condition. Sometimes in the country there is inflation, sometimes there is recession. So based upon that, the repo rates are fixed. So this is called one of the monetary policy tools of Reserve Bank of India also. So at present, the current repo rate is being fixed by Reserve Bank of India is 6.50 and this rate was fixed on 8th February 2023. Now the question arises, why RBI keeps on changing the repo rate? Why we always see that repo rates are changing? Now in this table you can see in 2019 repo rate was 6, then in 2020 repo rate came down to 4%, and now currently from 8th February the repo rate is 6.50, and recently we got a news that repo rate will not change, it is going to be same. So all this depends upon how much money is in circulation. So this is a tool which is used by RBI to restrict the flow of money in the market. So whenever there is inflation in the market, the RBI will raise the repo rate, and whenever there is deflation, the RBI will reduce the repo rate. So this is how RBI maintains the inflation. As we remember, in case of Corona, there was depression in the economy. So that is why the repo rates were reduced. And now again there is inflation in the economy. The things are getting very much costlier. So that is why the repo rate has been increased these days by the Reserve Bank of India. Now how the repo rate is used to control inflation. So when RBI increases the repo rate, what happens? The bank is going to borrow money from the central bank, which is going to be very costly. It means the bank will be paying more interest. So when bank is paying more interest, they will be restricting their borrowings because they know the loans are very costly, so they will not take much loans. So this is how the money in circulation will get reduced and inflation will be controlled. So in the event of recession, the RBI tries to reduce the repo rates, and this has impact on the various types of loans that the commercial bank further give to the customer. Now, who decides this rate of interest? This is the Reserve Bank of India governor. At present, he is Shantikant Das. They preside a bi-monthly meetings and with the committee. So they will be deciding what will be the repo rates. This committee is consisting of 6 members, and they together formulate, administer, and modify the policy rates. So how does RBI changes it? The entire committee changes it according to the liquidity crunch or surplus in the country. So depending upon the economic conditions, these decisions are taken. So now after going through all these discussion, we can conclude that this repo rate loans or transaction are the short-term borrowings because the bank is having need of the funds, and again they will be purchasing it very soon. So these are the short-term borrowings. So banks get overnight funds, term funds, and RBI keeps their securities for the time being. So banks repurchase the securities on a specified date and predetermined price. Price is already fixed. Banks takes the loan for the time being, and then the interest that banks give to the Reserve Bank, that is the repo rate. So what RBI can do? If the bank who has taken the loan and is not repaying the interest rate or the principal amount, RBI has been given the power that it can sell the securities in the market in case of defaulting banks if they do not give the money back. And the banks borrow money to deal with the deficiency of cash reserves also. Sometimes we all know that banks have to keep a CRR, SLR. So sometimes they don't have that much money, liquidity. So in that case, they take the funds from the Reserve Bank for the time being, and then they maintain their SLR and CRR. So this was all about the repo rates. In the coming video, we will discuss regarding the reverse repo rate and how it is different from the repo rates. Thank you so much.